We as humans are wired to behave badly, right? So we have shortcuts embedded in our brains, right? We have biases that are ingrained, whether it's recency, confirmation, we can rattle them all off. But these are biases that were actually really intended to help us distill a lot of information and make decisions quickly, right? And those are things that unfortunately do not fit well in the investment space. Worst case scenario, investor that's behaving badly, your recency bias, right? So they see the market's running hot, tried and true example, right? Where now is the time where they want to bring their boatload of assets into the firm and invest in the market that's already had valuations that are at their highs. They may actually see a short-term bump up as they're making this decision, right? So they focus on that recency and say things are going to just go up, or a confirmation of what they're thinking. They pile their money in really at the market at its highest valuation and most risk, right? And so you see that repetitive behavior, right, where they buy high and sell low, right? Contrary to the long-term investment thesis of the smartest investors in the world, Buffett and others. You can get investors to behave better, certainly first and foremost by acknowledgement, right? So helping them recognize that what they're experiencing or feeling is normal. So actually educate them on it. It's actually a fun thing to talk about, the biases we have, because you can relate them to everyday things, right? Like, are you above average driver? Of course, everyone tells you they're an above average driver. So relating it to very human things that they experience every day. Developing a plan, really, and getting their commitment to stick to that, right? So articulating the plan, making them, again, commit, even in writing, right? To actually tell themselves, this is what I'm going to do when I experience this market volatility or turmoil. Odds are they're more likely to actually adhere to that plan when they do so. To change that worst behavior in our investor base, it takes gentle nudges, right? I think a combative approach, kind of that full frontal combative approach, typically does not work, right? Because these are behaviors that are very well ingrained. So nudging them along, again, using examples, trying to turn the conversation, quite frankly, on its head, right? Liken it to scenarios like buying bread or milk. Do you go out and buy bread or milk when the prices are at their highest, or do you look for a sale at the grocery store? So gentle nudges, and then basically, again, if they're not confident, having them ease into a plan, right? So things like dollar cost averaging, right, which have very tried and true investment sense to them, can also have behavioral implications in that you're allowing that investor to ease into that plan. It's not a shock to their system. I think those nudges that are actually Thaler wrote about them, which you can certainly dig into those, I think are very important in terms of changing that behavior. A good way to get started in a behavioral framework is a simple letter to your future self, right? So engaging with that client, educating them a bit, right, on what they're most probably feeling, from a behavioral angst point of view. Simply getting them to write a letter to their future self saying, we knew this day would come, we knew the market is actually going to take a dip, whether it's 10, 15, or 20%, and here is what I'm going to do. And that's simple behavior, that simple nudge. It'll take them 5 minutes of time, but odds are they are most likely to come back and stay the course when that market volatility does creep in.